Welcome back to Global Risk Academy and the segment on market forecast and market activity, which is part of allocation of assets to allocation of risk. We're going to talk a little bit now about what kinds of benchmarks we should use when managing portfolios. Traditional portfolio managers love benchmarks when they can beat them. Of course, they hate losing to them. But a lot of money is managed in the world by simply picking a benchmark and shaving a little bit off of some of the stocks that are less popular with the manager and adding those segments of money to those portions of assets to portions of the portfolio that the manager thinks are more attractive. That's asset management, that's asset allocation. In looking at portfolio benchmarks from a risk standpoint is entirely different. Instead of setting up a portfolio based on assets and percentages of assets, a portfolio that's based on risk and percentages of risk will look totally different. Cap weighting is the favored way to put together a benchmark because it shows the size of each of the individual markets, which is another way of saying that the reason why Japan is bigger than Germany is because it's grown to a higher level than Germany has, and China has now grown to a higher level than Japan, and the United States is still the largest market. All it does is it says where economic activity has been successful, and it tells you where market capitalization has found a home. It doesn't tell you much about the forecast for what countries or what markets are going to be successful in the future. The only way to know that is to either make a market forecast, which makes you smarter than just about everybody else in the world, because you have to be brilliant to come up with forecasts on a continual basis, or you come up with a systematic approach to using risk allocation to try to find the best places to put your money. Bloomberg did a study a few years ago. They brought in 3,000 or so allocation forecasts from economists, from asset managers, from people who provide index services, and they tried to see how accurate these forecasts were over time. And without going into all the methodology, it was assured that somewhere around 10 or 15% of the forecasts actually came true. That's a pretty bad betting average if you're putting your money where your forecast is. So what most people do is they forecast, but they do it frequently so that they can change their mind about France or Germany, or change their mind about whether they think the IT segment is going to outperform the telecoms. Because they need to, because they can't anticipate all the events that are going to take place this week, next month, and thereafter. We look at staying in tune with the markets as a better solution. Rather than forecasting, reforecasting, and then reforecasting yet again based on all the information available, we'd rather use statistics and math to figure out where the best risk-adjusted returns are in real market time, and to try to figure out how to allocate to those best returns and get the best benefit of the return on our capital, which is another way of saying the best return on risk. When we construct a benchmark, we'd much rather take the components of the benchmark and look at them as optional risk that we can take. When we do that, we're not inclined to give much weight or any weight to the capitalization of the markets, except for purposes of determining liquidity and determining the market size so that we know the point of entry, point of exit is a place where we can do an actual trade. So limiting market exposure by the size of the market is a good idea. We need to make sure that we don't put our capital at risk because we can't get into or out of a situation where we've made an investment. What we do want to do is allocate freely to the best risk-adjusted returns. And those sources of return, according to our framework, is certainly going to change over time. We're counting on it to change. In fact, we're betting that the likelihood that a static portfolio is going to be the right portfolio is zero. We don't think that can happen. We think that we can take smart beta, which is the adjustment of the allocations to different stocks or countries in a portfolio, and make it much smarter if we not only make it smart on the first day, but we continue to allocate according to where the best opportunities are going forward. Staying in tune with the markets is what risk allocation is all about. Risk allocation is anything but static. You can do risk allocation on a daily basis the way we do, or you can do it on a weekly or a monthly allocation basis. But risk allocation forces you to be in the business of keeping track of where your investments are versus where they were when you made them initially, and making sure that the investments make as much sense down the road as they did when you first started. That's going to require you to be flexible and be able to make changes. So when we set risk limits based on the criteria of making sure that we don't over-allocate to something with an enormous amount of downside. We want to make sure that we measure risk-adjusted returns, and we want to make sure that at the end of the day, we have a lot more upside than we do downside in our investment portfolio. We're not afraid to go to cash in times of crisis. In fact, we think that's a good idea to be out of the market when the market doesn't really want to treat our investment money with any respect. We also know that we can use the same risk-adjusted returns and the same framework of the bubbles, both from the risk standpoint and from the risk-adjusted return standpoint, to give us the criteria we need to know when to get back in. So it's basically a two-edged sword. One side of us is looking at the risk of a portfolio to see when the downside and when the correlation looks like it's getting too high for comfort to take us out of positions that are behaving badly. The second part of the equation is constantly running the risk-free rate and the risk-adjusted return analysis that will give us an idea of where we can take our capital to find the best possible returns for the risk that we take in the portfolio. If either one of these are telling us that we can't really find a good risk-adjusted return, or that the risks are just simply too high to make sense out of a Sharpe ratio, then cash is a good place to go. And history has borne this out to be a very good idea. Because if these metrics don't produce opportunities for us to invest, we really shouldn't force it, because it's highly likely that they don't exist. So, a minute ago I said that if you were going to make forecasts, do it often. A lot of people have made jokes out of that. But I think that what you need to understand about risk allocation is that risk allocation is not a joke. It's a process. And one of the things you have to know about measuring marginal Sharpes, and you know about making risk allocation decisions and swelling bubbles so that they can have more benefit in the portfolio, is that this analysis will be wrong from time to time. There is such a thing in the marketplace as a whipsaw, and it happens very frequently, and it doesn't give much warning. A country, a sector, a stock may show signs of having a very, very good risk-adjusted return over whatever time designation you've used to use it for allocation purposes. That may completely reverse itself. That country, stock, or sector may decide that it's been a really good ride for a risk-adjusted return, and it's over, and it can turn on you, and your bubble goes south and below the point of demarcation, and it turns very quickly. So what do? You're measuring so frequently in the risk allocation business that you don't worry about that too much. The name of the game is not to worry about the mistakes, it's to get out of them quickly, so that when they turn south, and they're not doing what the program thought they would do based on the risk-adjusted return behavior, you get out of them. And you're not afraid to get out of them because there are other bubbles, which are risk positions in your portfolio, that probably are behaving better and probably are pulling the Sharpe ratio of the total portfolio up to the point where they deserve to get allocated more risk, and perhaps they will be more stable return. The marginal utility function cannot be overestimated or stressed in this part of our video. Marginal utility function is where risk-adjusted return lives. Marginal Sharpe and the second derivative of marginal Sharpe, which is basically a stability measure, are critical to understanding where portfolio benchmarks should be allocated. By stabilizing the marginal Sharpe utility function, using the second derivative of marginal Sharpe, an asset allocator can calculate not only what the Sharpes are, but what the stability factor is, and smooth out the allocation changes. Again, I want to point out, we anticipate being wrong, and we anticipate making changes, because nothing is foolproof and nothing is forever. In the portfolios that we manage at Ferrell Capital with our Concert program, a long time of holding the country might be 2 or 3 weeks, and a short time might be a day, might be 2 days or 3 days. But when something is not working well, we're not afraid to go somewhere else. And when something is working well, we're not afraid to allocate more to it.